Welcome back to the Investment Conversation. I'm Andy D'Souza, Partner and Chief Marketing Officer here at Lord Abbett. As part of our 2026 investment outlook, we're going to talk with our investment leaders about key themes for the markets in the coming year across equities, municipal bonds, taxable fixed income, and private credit. Today, I'm here speaking with our co-heads of taxable fixed income, Steve Rocco. Hey, Steve.
Thanks for having me. Excited to be here.
Glad to have you here, Steve. And Rob Lee.
Hi, Andy. Great to be with both of you again.
Again is right, Rob. Awesome. So last time we were together in this room speaking on the podcast, it was halfway through the year with our mid-year outlook. A lot of things were happening. We had just sort of come off of Liberation Day. There was a lot of noise and a lot of news out there to digest. But just taking a step back where we are today now as we enter the end of the calendar year 2025, what do you guys see as far as big picture in terms of just the economy in general? I'll put it out there. So Rob, what are your thoughts on the economy overall?
Sure. I think the single best word to describe the U.S. economy, we'll talk about the U.S. first, is resilient. As far as I can tell, we haven't had a recession and are not in a recession right now. Growth has been positive, and that's despite some pretty significant changes in trade policy and the tariffs that you alluded to. Liberation Day was the height of the tariff fears and uncertainty. But here we are towards the end of 2025, and we've seen positive real GDP growth in the U.S. Why is that the case? Well, I would point to a couple of things. The first is a number of different adjustments by the Trump administration on tariffs. There was a 90-day delay. There are exemptions for certain countries and certain goods. There have been trade deals. You could also just view it as prudent adjustments and negotiation. And that's one reason we didn't get the worst of the, maximal tariffs. The second reason is corporate America and corporate world are quite resilient and resourceful and creative. They will and have found various ways to adjust to whatever the policy is. It helps when the policy is set and more stable, but it's, I think, pretty clear that we have more certainty around it more than 7 months later after Liberation Day. So decent growth in the U.S. It's not gangbusters. It's lower than it was in the second half of 2024. But we're sitting here towards the end of the year, and things look like we're in pretty good shape.
Steve, what do you think?
Sure. Let me just add on here. So, I'd say, Q3 looks to be shaping up 3 to 4%. That's a pretty strong quarter, probably the strongest we'll have this year. Rob is right to say that it seems like the worst expectations for tariffs have not come to pass. That being said, like in Q4, we've had a prolonged government shutdown, which will, I think, lower growth in Q4. I think that's what the market's a little bit worried about. But I also at the same time have inflation coming down in Q4. Now, the struggle is we haven't had a whole lot of data, but we can look at inflation swaps, which are now down to 2.5. So you have a Q4 setup of kind of slowing growth and possibly a little bit lower inflation still above the Fed target. And I think, for me, the big thing is kind of this upcoming Fed meeting where, expectation right now, it ebbs and flows, but it's about 50-50. And my view is they actually should cut here. And it looks like we have a very divided committee. I think that's what the market is kind of struggling with at the moment. But that could be a very temporary thing because if we kind of fast forward to Q1, you'll see more fiscal kind of play through. And also you'll probably have a new, in May, you'll definitely have a new Fed chair. You'll have an announcement of who that is pretty soon, actually. And I'm assuming that that person will kind of drive an agenda that will mean lower rates. So I think what we're experiencing right now, although very minor, could kind of resolve itself to the positive as we head into Q1 next year.
What about the consumer, guys? I mean, it's a large part of the economy, obviously. Data's been a little bit, hard to get these days, perhaps you might say. What are your thoughts on sort of those two things, the consumer overall and this whole idea of the data not being there, not being as clear or being as current?
Yeah, so we have other sources of data, obviously. You have alternative data. You also have data from, large retailers. We had, obviously Walmart report yesterday, which is actually pretty strong. But there is some effects, right? You're seeing a trade down effect for sure. You're seeing pressure on the subprime consumer, actually more pressure on the near prime consumer. Because I think those are the folks that you may have got too extended, where the subprime consumer kind of living in the world that they've been accustomed to, which is dependent really on on kind of variability in oil price. When oil prices are lower, that's to the benefit of the subprime consumer. I think it's where you seen a little bit of aggression. It's been more in that near prime, and that's played out. But in aggregate, the consumer data has actually held up pretty well, pretty strong, and most of the spending, as we know, is kind of the upper tier. So that accounts for 80+% of consumer spending. So while there's pockets of weakness, I'd say in aggregate it's still pretty strong, right? That's the Q3 data we talk about. But there's no doubt there's been a little bit of a slowdown in Q4. And as I touched on, some of that's government shutdown, right?
Yeah.
But there has been a general slowing that we've seen in the data. We talk about like restaurant spend, kind of food away from home. That's kind of one indicator I look at, and that's kind of slowed, not rapidly, but it's moderated.
Yeah, if I had to add one thing or put my take on it, another construct or framework you can use is what economists call the K-shaped economy. I'm sure many listeners will have heard that. The K, the top part of the K, capital K, I guess, is the high income, higher wealth cohorts. And the bottom part of the K is the lower income, lower wealth cohorts. What Steve's referring to is the bottom part of the K has faced pretty great pressures. Some of it is because in recent years we've had pretty high inflation. So even though inflation rates have come down, the price level is pretty high. And that makes it more challenging to meet for discretionary spending, and to meet your day-to-day, everyday necessities. And you're seeing some signs of that in subprime auto delinquencies, for example. And Steve alluded to that. The upper part of the K is doing quite well because until recently, but overall this year, stocks are up, cryptocurrencies are up, house prices are up. Wealth, household net worth is very, very high. It's near all-time highs. And the majority of spending is done by the wealthier, higher income cohorts. The real question and a real, I'd say, tension and key question for the coming year is, to use another letter, if you use a capital E and you talk about, instead of high and low income and wealth, talk about high, middle, and medium and low, how does that middle category do? And there are at least some concerns about some of the headwinds that the lower part of the E are facing might spill over into the middle.
And then, frankly, the labor market has kind of stalled here, right? Not a lot of hiring or firing. Slowed down. We got some data for September, and you saw the revisions for July and August, which were negative prints. We won't get kind of payroll data in November. You'll come after the Fed meeting in December at that point. But the labor market will be key here, because if you start seeing, layoffs and a weakening labor market, then that's going to affect a broader subset of consumers, what we're talking about here. And that'll play through the aggregate data. And that's one of the reasons why I think the Fed should keep cutting, because they are restrictive, and the labor market's weakening. And so I think it pays to get closer to what they believe their neutral rate is. And I actually believe they'll do that. But it's now an open debate here, but you have a couple of weeks to find out.
Right. You can't talk about the consumer in the U.S. economy without talking about the job market. And Steve, I completely agree, is right. The way I'd characterize it is low hiring rates, but also low firing or layoff rate. Another way to say it is kind of a low churn, low turnover. There's been a deceleration from, say, a year ago, from 2024, in job creation and new jobs. Some of that is probably due to the changes in immigration policy and net immigration to this country. But there's no doubt there's been some deceleration. This is why the Fed has started to resume its Fed cutting campaign. They cut 50 basis points in September and October of this year, just a couple of months ago. After pausing, they cut about 100 basis points. They cut 100 basis points toward the end of 2024. They paused for 9 months, and they've resumed that rate cutting path. They see the restrictiveness, they see the softness or the deceleration of the labor market, and they are resuming their rate cut path to, I think, buy insurance. They call it risk management cuts. Buy insurance because for the labor market in the U.S. economy, because monetary policy, as we all know, works with a lag.
And last time we spoke, Steve, you had mentioned the idea that the subtle difference between the sort of the soft data and the hard data. Is there anything here sort of diverging from that sense, or it doesn't make sense in the whole equation of what's going on?
Well, it's hard because we haven't had any data here for months. So there's really it's hard to see what divergences are. Generally speaking, the softer data has been a touch weaker. Some of the confidence data, some of the survey stuff has been weaker. I'm talking about like Michigan consumer confidence. There's also been a split between Republican and Democrat, which you see often when it comes to this confidence data, depending on who's in office. So there's that. That being said, like we had a series of kind of data releases here in the last week or two where you saw some of that soft data on the service side in Europe, service side in US kind of holding okay. So nothing super, super troubling, but we'll get more data kind of as the months pass. We're not really going to know, is my point, until probably January, February next year when everything kind of plays through and we get all that data catch up. And I think that's contributing some of the uncertainty that we're talking about here. Because the market's been flying blind, and so is the Fed at this point. But from what we can tell, I think the economy slowed a little bit. And whether it's soft or hard data, but it's slowed a little bit.
Gotcha. We talked about here monetary policy a bit. On the fiscal side of the house, fiscal policy, what are your thoughts there, Rob?
I would call fiscal policy neutral to positive. So the big picture is the One Big Beautiful Bill Act got passed earlier this year. And it was net stimulative. It wasn't hugely net stimulative. It isn't increasing the deficit, the federal deficit by huge amounts, but still net federal government spending. And that will boost the economy, all else being equal. How that gets distributed is an interesting and relevant question. And I would say, broadly speaking, for corporate America and parts of the consumer balance sheet and consumers, generally positive. So I think you should expect net stimulus from a fiscal perspective. There is a timing issue there too, because it doesn't always over a 1 or 5 or a 10-year window. It's not always exactly smooth or even or level. And I would say in the first half of next year, you should probably expect some net boost. That's the way the provisions were set up.
That's right. Got it. And you mentioned first half of next year and looking out. So the bond market is supposed to be looking into the future and telling us what it sees. So with that backdrop in terms of the economy and fiscal and monetary policies, what's the bond market telling you guys right now?
Sure. Let me start with credit spreads, and then we can talk rates. We can talk about shape of the curve. It's hard to deny that credit spreads are tight. When you look at historical measures, you talk about investment-grade corporate bonds. We could talk about high-yield corporate bonds. We could talk about commercial mortgage-backed securities. As a general statement, credit spreads are pretty tight. They are not at the year-to-date tights. They've given some of that back and widened a bit from the tights 5 or 6 weeks ago. But when you look back 5, 10, 20-year averages, we're pretty tight. I would argue, though, so that's a fact, I would argue that, generally speaking, those tight spreads are reflecting pretty good fundamentals. Let me explain, giving a couple of examples. We're almost all the way through third quarter earnings for larger companies. And this is true for both the second quarter and third quarter. Pretty solid. That's true at the top line, the revenue line. It's true at the bottom line, the net income line. It's true for corporate margins. It's not universally true for every company or every industry or sector. But broadly speaking, we're talking about mid to high single-digit increase in revenue. Use S&P 500, which is not the perfect proxy for bond sectors. And low to mid double-digit net income growth. And this is at a time when there probably were some headwinds, right, from uncertainty around tariffs and things like that. You might have seen it more in the second quarter earnings than the third. But broadly speaking, corporate America is doing pretty well. We already talked about consumer balance sheet with some differences by income cohort and wealth cohort. Pretty solid shape. When people have jobs, the unemployment rate, the last we've seen, is 4.3%. It's off the lows, but it's pretty low historically speaking. So I'd argue, from a corporate America point of view, pretty healthy fundamentals. From a household point of view, broadly speaking, with some differences. I'll use one other example. Let's talk about commercial and residential real estate. In pretty decent shape. We had 525 basis points of rate hikes back in 22 and 23 that made housing affordability and spiked mortgage rates both on the consumer and the residential side. That was pain. We're a couple of years past that, and yields, treasury yields and mortgage rates, both commercial and residential, are definitely off the highs. That should be a boost and make affordability better for home buyers, some refinancing and monthly savings in your monthly payment. And on the commercial side, lower cap rates, which should be good for heavily financed sector. So I won't say it's universally good, but I'd say the credit spreads are reflecting good fundamentals as a general statement.
The pitch you paint there, Rob, it seems pretty benign. Seems okay. Things seem okay. But there are some headlines creeping in now about some certain episodes or instances in the market. Let's call it the cockroach comment, right? There's a couple of things that hit the news recently. Do you see these as sort of idiosyncratic flare-ups or something people want to see? It feels like almost like a canary in the coal mine. They want to see something and read into this a little bit more. What's your take on some of the problems people are having now?
So I'd say we've talked about this in the past, kind of with the rise of private credit, right, and also the changing in the broadly syndicated loan market. And I'll touch on some of those kind of questions that you asked here in a minute.
Sure.
But the reason why the high yield market trades as tight as it does and investment grade is because a lot of the lever, I'm not going to say bad lending, but the lower levered lending went to these markets, right? Which leaves the high yield market relatively cleaner. And that's one of the reasons, among many. I mean, the high yield market's also shortened, that spreads are what they are, maybe kind of justified. Now, there is a vintage problem in private credit. I think it's shocking to say. I've been saying it for years. Now it's coming through, right? And that's that 2021, maybe 2022 vintage. And if you remember what was going on in 2021, you had zero base rate and it was a little bit of euphoria, right? And there's certainly a lot of capital there that, needed to be deployed, and naturally you see a loosening. And I think that is what you're seeing, right? With some of these. And by the way, not all of it's private credit, right? First Brands was a broadly syndicated loan. Let's make that clear, right? Private credit folks owned it, but it was a broadly syndicated loan. But I'm expecting you'll see more, right? But I don't think it's a systemic risk because by definition, private credit, it's not like the financial crisis, everything was on a bank balance sheet. This is off a bank balance sheet.
Mm-hmm.
And it's in private hands. But I do think you'll see more of that play through. Now, for it to get worse from here, I think we need to see the economy get a whole lot worse from here. But there still is pressure, right? Because base rates are still relatively elevated and there was lending that probably should not have gotten done. And so I'm not surprised to see it. Now the media is all over it and they're going to, report on every single default. But and this gets into another thing. There's a lot of dispersion, right? There's dispersion amongst BDCs, right? There's a lot of the larger BDCs. If you look at the non-accruals, there's not many, right? And you look at some of them, there's some problems, right? And the same is true in credit markets, right? There's a lot more dispersion now than there was, let's say, when we were doing this podcast 6-7 months ago. And I expect that'll continue, and that hopefully plays to the benefit of an active manager where you can kind of pick and choose kind of where you want to be. But I think it's more a systematic thing than systemic when it comes to this, where you may see more and more and more. So I don't think there's just one. But for the same time, if I look at credit markets in aggregate, and I touched on the private non-accrual, but if you look at high yield default rate with distressed exchange is 1.5%. Without, it's about 0.5%. Maybe you elevate a little bit next year, but if we have the outlook right, I don't think you elevate all that much. You may not even elevate at all. And so that's why I think it's much more of a resilient asset class. So, we'll see, kind of what happens here, but I think there'll be more. And I think the media, as always, will kind of be focused on it, and they are. But you got to kind of take a step back and not paint everything with a broad brush. But no doubt, 21 vintage, I'd have some worry.
So more of maybe a vintage isolation in some sense issue. So maybe more cockroaches, but not an infestation.
That's probably
That's
right.
right. Think about it.
Yeah, let me add a comment or
Yeah.
two here. So, Steve and I broadly agree here. So Jamie Dimon, if I can use that name, who it's public, so he talked about there's never just one cockroach. You should expect more. I generally agree with that as a blanket statement. When the credit markets, when it's a bull market, when the economy is strong, when the credit markets are open and liquid and issuance is getting done, throughout various cycles, lenders sometimes get lax. I'm not saying we do very detailed and rigorous work. But the system as a whole, it naturally happens. It's just the nature of cycles. So do I expect more? Yes, and we've seen a few more. That's the first statement I would make. Is the media hypersensitive and will report on every single one of those in a very large, with thousands and thousands and tens of thousands of loans and companies? Of course there's going to be dispersion. Of course there's going to be some. So there'll probably be more. I think it makes sense. But the second question is, how many and is it systemic? I'll make a general statement. I don't think it's systemic. I agree with Steve. Some of if you're talking about private credit, I would argue it's in very strong hands. People who are investing in private credit, as a general statement, know the liquidity of what they're investing in. They know the risks. You don't get high yields and wide spreads for nothing. It's pretty locked up, stable capital as a general statement. We don't know, and most people don't know, including the end investor, doesn't know exactly what's in those portfolios. And the opacity, the lack of transparency there means nobody knows for sure. The very last thing I'd say is, in private credit, a large majority of it is floating rate. The Fed has cut 150 basis points in the last year and change. That, all else being equal, eases the debt service burden for all those issuers. If they need to do more, they will do more. We'll see what happens in December. But don't forget the big picture. And the big picture is the Fed's cutting. That's going to make servicing debt easier. It won't save over-levered capital structures. So I think there's room for caution. We probably see more. I don't think it's systemic.
The other thing I'd say, just to touch back on what Rob was saying, like the bigger kind of headwind for public versus private may just be more the rate story, where yes, it helps from a company perspective, when your interest expense moves lower and the economy holds, but also, we're dealing with floating rate instruments. So rate, kind of your forward, if you're right on the Fed and the Fed keeps cutting rates, your yields are coming down.
Yeah.
Right. That could be the bigger story than the actual credit cycle turning. And that may favor more of a fixed rate exposure. In fact, that's what I believe, right? And so that may favor an asset class that, like IG or high yield, relative to private credit. We can move away from the hysteria of like default cycles, right? And that may be the bigger driver. And private credit spreads generally, when what you see when the front end comes down, is you see those spreads come up, so they'll kind of offset. And all that being said, like the time to do deal, I like, we talk about the 21 vintage. I think the 24 and 25 vintage are great for that reason, right? Because it's kind of eyes wide open on base rate. You're getting wider spreads, right? You can kind of forecast out what you think the base rate's going to be. You can, much more, I think, a reasonable environment than 21. So that goes back to like, pick your manager wisely, right? And I'm excited that we launched our efforts in 24, and I think it was very well timed. So like, to me, that's a huge opportunity, right? And that actually excites me, right? But there's no doubt going to be kind of more to play here as we kind of walk through it.
And what about technicals in the market as far as supply and demand, and whether it's high quality sectors or leverage credit sectors? What do you guys see in terms of supply and demand?
So generally speaking, let's touch on different markets. High yield issuance is up. Net issuance up a little bit. Projecting out about a good year for high yields, about 300 to 350 billion gross issuance. Project that for next year. If you want to take the over, it would be a more robust M&A environment. It would be, high yield market has shrunk, right? We talk about like kind of move to BSL and private credit. And maybe some of that comes back into the high yield market. But overall, I'd say kind of relatively tame from the supply side. Still a lot of refi, and still a lot of demand for yield. Okay, now IG, you see an increasing supply in IG. Rob knows better than I do, but I think maybe the projection next year is like 1.7 trillion, 1.8 trillion.
Depends on who you ask, but a little.
Yes, but what's happened recently there, it could go higher. I always take the over in IG supply. There, I mean,
Why?
it could be M&A. But what's happening in IG is really, we haven't touched on AI yet, right? It's the hyperscaler spend, right? And so to the extent you believe that, and I think it's very believable, and some of this will be on balance sheet, some will be off balance sheet. We can get into that if we want. Some of this will be JV, some will be on balance sheet. But if you believe the spend, which, by the way, everyone underestimates every year, if Matt DeSico was here, he would tell you that, and it's true, then you'll probably see more IG issuance. You may even see more high yield issuance, right? Because we now have about 100 basis points into the index of what I call AI supply. And so you'll probably see more of that because there's definitely a big capital need. You'll probably see more of that in private credit too. It's kind of all hands on deck. So on supply overall, I'd probably, sitting here right now, given my outlook, I always follow Say's law, supply creates its own demand.
Here's the only thing I'd add, and maybe I'm just saying it a different way than Steve said it. I'd say when I look at supply and demand in fixed income markets, I'll talk about high quality fixed income. Balanced. So supply, as Steve said, is high. That's true for gross supply. It's true for net supply. I wouldn't say it's extraordinarily high, normalized for the size of the economy, the growth in U.S. and global population, past years. It's not, off the charts by any stretch of the imagination. But the federal government runs $1.5 or $2 trillion deficits in recent years. They have to finance that somehow. So the net supply of treasuries is roughly what that number is. So you're talking about, let's round, almost $2 trillion a year. Investment grade corporates, Steve gave you the numbers. You're talking about in gross supply. I'll use a point estimate. The year's not over. 1.8 trillion this year. Roughly a third of that's net supply. So call it 600 billion. So there's growth there. It's true in agency mortgage-backed securities. It's true in some of the smaller sectors too. So you have a healthy supply. Steve said it. Demand's pretty healthy. That's true on the retail, mutual fund, and other vehicles side. It's true for lots of other institutional investors, think banks, insurance companies, foreign buyers in general.
Yeah. I think, Jonathan, the market's good. The market's accepting of the supply. I mean, there are periods where you see maybe it's shocking in that indigestion, period, we saw in IG in the last month or two, where I think, some of this was done off balance sheet and some of it came on balance sheet, and the CapEx numbers were ratcheted up and the market had to adjust to that. And then it did adjust to that.
You touched on this, Andy, and you alluded to this, and so did Steve. The very large, I call it massive, projected build out of AI, Gen AI, data centers, the power the power generation needs to power all that is a big deal, and one needs to think about it, and it will affect supply. So Steve talked about some of the big hyperscalers who are the largest companies from a market cap perspective, who are investing hundreds of billions of dollars a year in this build out for lots of reasons that we can talk about, will slowly and already starting to affect supply, nets and gross supply in fixed income markets, and the composition of it in terms of sector and issuer. It's important to have a game plan and to be thoughtful around that. There's a lot to be discussed on this topic, but I can assure you that we've been thinking through it and studying it very closely. And I would say here, we believe that it is still pretty early in the build out. We're still building the infrastructure, if you will. Think GPUs from NVIDIA and other semiconductor makers. Think the build out of data centers to power the training of AI and training and inference. And the power in the grid to, provide the what's needed and massive power needs for that. So I'd say we are thinking about it, and there are both opportunities and risks here. I can expand.
I mean, generally speaking, right, just to touch on a few things there to follow up on what Rob's saying, like with these big infrastructure builds, right, like, and you can go back to telecom in the 90s. I even put energy, shale revolution, which high yield financed, right? And now AI, they usually end in bust, right? But there's usually a benefit, and the benefit goes to the user and the consumer, right? We're all better off for having all that fiber deployed in the 90s, right? We're all better off for the shale revolution because we have lower oil prices, and I think we're much better off in AI. So you have to be careful, because I'm willing to finance a data center build, right? I'm willing to finance certain things, but the history of these things, you see a lot of issuance in one sector. Your antenna should be up, right? And you want to be very thoughtful from the top down. That's what we're encouraging the teams, because you can get very marginal very quickly, right? In terms of how things are done, and get very loose very quickly. And get a lot of, you saw that with high yield and U.S. shale, where it started with the best and it got to the worst, and it was in a completely oversupplied situation. And that could happen here.
Let me give you one other example of
Go
the
on.
opportunity, because I agree it's early, but we have to be very vigilant. So if the big hyperscalers, these tech behemoths, need to issue 20 or 25 or $30 billion of debt, multi-tranche at a time, more than once a year, they usually have to come at a price spread yield concession. They have to make it attractive to place all that paper. These are massive cash flow, and despite all the CapEx and investments, most of them still free cash flow positive. These are AA and AAA rated companies. And if you come at a nice concession with very creditworthy household names with moats and real giant businesses, it's attractive. How long you want to stay around, how you monetize or take profits or not, is key to active management, and something that, is what we do every single day. That's the opportunity side of it. It's true on the high yield side and the leverage loan side and the private credit side and securitization side. There's ABS and CMBS data center securitizations, and they're not all created equal. And sometimes they come at very attractive levels. You just have to make sure you understand where this is going and study it very closely. Be very selective, choose the best assets, benefit from this build-out and the high issuance needs. We went from primarily cash flow finance for this giant AI build-out and data center build-out, and now it is increasingly moving to debt financed, and that's our world.
So we've gone through a lot of the ideas in terms of what are the challenges and opportunities ahead of us here. You give me a challenge or opportunity, I think, but maybe one that we haven't talked about yet.
Okay, I'll start. First, let me cover high level, the key debates, questions that we need to answer, the things that we're really focused on. We touch on them, but I think it helps to take a step back. One is this whole AI technology, hyperscaler, data center power build out. Very important. If, not a prediction, if it's a bubble and it crashes at some point, I'm not saying it's a bubble, by the way, that will have ramifications across all capital markets in the U.S. economy. So that's a key debate, question, thing that needs to be studied. I don't think it's a bubble yet. I think there's some frothy signs, but I don't think it's a bubble yet. That's just my view. I can elaborate. That's number one. Number two is what I would call, we talked about the economy. So this is pretty healthy GDP data, but a softer labor market. Is that a wedge or discrepancy or tension? There's an argument to be made that it is. You usually don't have both of those happening simultaneously. And if one resolves in the direction of the other, meaning GDP starts to weaken a lot and in a sustained way and we go into recession, to match a softer but not falling off a cliff labor market is key. Or does the labor market start to rebound and stabilize? That's a key number two. That's kind of the number two key question to me. Third is cockroaches, credit cracks. Is it systemic? How many more are we going to see? How bad is it? This is true for private credit and payment in kind. This is true for lots of credit markets. The fourth is the consumer. We talked about K-shaped and E-shaped and, low income and high income. All key debates. Those are probably my top four right now. I'll give you one or two more that, and this is really the gist of your question, that I'm thinking about. if inflation ticks back up, stays stubbornly high, most inflation measures, there are dozens of them, around 3%, that's above the Fed's target of 2%. I think it's likely, my base case, and I think Steve agrees, likely to keep coming down for various reasons. But if we're wrong, and through various factors, we get a surprise and it stays here and or goes higher, it's going to make the Fed's jobs harder in terms of its cutting campaign. So an unexpected and or sustained increase in inflation would be bad for risk assets in general. That's one. Somewhat related, and then I'll stop with two, is I think even though copious amounts of work and research and articles have been spilled on this topic, I still think it may be underappreciated. It actually ties into all the things we've been talking about so far, is the immigration trends, the effect on certain industries, the effect on wages. It has an impact on labor supply, on wages, on potential GDP growth. So how that all plays out, I think it is still perhaps an underappreciated impact on various parts of the economy.
Got it. Steve?
Well, Rob gave you 8. I'll give you 1.
Give me 1.
It was broad. I mean, so it's something that just on my mind, right? We touch on kind of what's worked in the market, right? There's been earnings power, right? And that earnings power is generally coming from the large cap, right? Tech companies, not all of it, but most of it, kind of the free cash flow generators. And maybe that free cash flow isn't what it, was in the past, because what we just talked about, they're spending more, right? And so that they lose some of that kind of free cash flow yield edge. And then we're talking about this idea that you kind of roll into Q1 of next year, and it's also midterm next year, which is important here. And, we're maybe in a little bit of a lull here, but if we're right, kind of Q1, things pick up. But then, the market's priced in a lot of cuts, which may or may not happen. But you also now are going to have a new Fed chair, right? And I'm assuming that new Fed chair is someone who's going to cut. That's my assumption. Right or wrong, maybe there's more debate and discussion, but probably someone who's going to cut in the face of inflation that's not at target, right? In maybe what's possibly a cyclical acceleration, does that unleash a little bit of animal spirit? So that higher nominal environment. And then from the standpoint of, what's worked in the market, has been the tech stuff and the AI stuff. But maybe you get a little bit more of cyclicality, right? Which hasn't worked in the market. And part of that, is driven by the economy, accelerating, and you have the housing market unlocking, which quite frankly, right, is another one thing that's that's stalled, right, with higher rates. And I think the administration is very focused on housing. And then that, that whole kind of chain gets working, right, and you unleash that cyclicality earnings power. And maybe it's a better year next year for cyclicals versus tech, which is not how people are positioned, I would say. So those are things that are on my mind. I think plausible, or it could just be more of the same, where the winners keep winning, and the large caps keep winning, but maybe not. And I think that'll play well towards a down in quality type exposure. Generally speaking, that's what happens in a higher nominal environment.
So a lot on your minds, a lot of opportunities, but a lot of things to be concerned about in a healthy way as well. Guys, thank you for the time today.
Thank you.
Really appreciate it. And Happy New Year pretty soon.
Yeah, great to be here.
Thanks, Rob.
Thank you, Eddie.
Thanks, Steve. This has been the Investment Conversation. Be sure to visit LordAbbett.com to find our complete 2026 investment outlook, along with other market and economic insights. Thank you all for listening.